Now to help us dial in on some of the fundamentals behind this rally and this technical move higher, let's bring in Bill Baruch, president of Blue Line Futures, joining us this Monday morning. Bill, good to have you with us. Gold at record levels. What's it telling us?
It's always a pleasure to join you. Thanks for having me. Yeah, it's been an interesting move here. I mean, heck of a move. It's sort of the thing we've been waiting for since 2011. Now getting some real follow through. You've talked about rates. I think it's really interesting that we've seen rates continue to go higher and gold really continue to make this move. And you know, something I've been speaking of is you look out. There's obviously central bank buying. How is that central bank buying being concentrated? And we know that China is defending the Chinese yuan. They're selling dollars, buying yuan. As the yuan is at a really critical level. But if you look at BRICS, when you start looking at Brazil, Russia, India, China, South Africa, you know, is anybody selling treasuries, and are they turning around and buying gold? Is there something there with that? I mean, we do know that treasury supply is been, you know, coming from our government is weighing on the prices, but there's definitely been a sort of divergence here that we haven't seen before. And it's almost acting as a tailwind for gold here. So it should be interesting to see how this continues to play out with some big data this week in mind as well.
Yeah, I just want to look at some of the price activity. I've got a side-by-side here now just to show you on the right side of the screen, 10-year yields, which have continued higher. On the left side of the screen, now not to the same extent that gold has, but you can see this run up here, gold in the face of higher yields. Now, maybe this is because the dollar hasn't participated. We're going to talk a little bit later about, I think that's why stocks have benefited throughout all of this, right? They've managed to shrug off higher yields because the dollar is relatively contained. But here, stick with these charts for a second, because as we move away, again, gold on the left, 10-year yields on the right, both marching higher. I want to point to how, well, look now, silver on the right? This has provided opportunity in some of the other metals as well. And I know you watch, Bill. You've got silver, copper, right? There's some talk about China, and some of these industrial metals have benefited as well.
Yeah. Oh, I'm not just watching. I'm trading. I mean, we run a metals fund here, so this is what we've been waiting for. It's really you know, sort of our Super Bowl. Now, yeah, I think a lot of this most recent leg did come after Chinese manufacturing data was a bit better than expected, and services were hanging in better too, as about a week ago over the prior weekend. And that gave us a tailwind into this week. And, you know, if you look back, 1910 was the high back in 2011. We had the low to 2015, which actually came like a day after the Fed actually hiked rates. You know, when they're going through that hiking cycle and then hiked rates back in 2015. That extension to 23.44 is the overall 50% extension if you flip that up, and then really that brings us a target of 2,800 and overall. So I think there's really some room here to run. But if you look back at just the most recent high in December, when we went to 2191 and then retreated, then that overall was would give you 100% extension back up to 2366. So running into some pretty interesting technical levels from going back to 2015 when they started hiking rates and then gold bottomed upon that. So there is these sort of divergences in historically where you think that the actual gold doesn't respond, because when yields are higher, the issue would be is storage costs, and gold is not a yielding asset. So when yields go higher, gold typically it acts as a headwind for gold. So that would be something here that really just these divergences are of the normal almost.
Yeah, geopolitics, some of the other factors that have added to the bid, one could argue, have eclipsed the headwind that you talked about in terms of rates. And as I mentioned, the dollar really hasn't participated to the same extent. Here it is stuck at this 104 level, right in the middle of this 104 level. Hey, we just looked at gold holding above the 50, holding above the 200-day moving average, and the retreat we've seen away from those closely watched levels basically since it looks like February we've been above them. I want to take a look here because copper also, we mentioned silver, it's benefited. Copper, here's a look, it's been above the 50 and it's now inching its way back to levels we haven't seen since the beginning of last year. So something something to watch there as well. This is even in the face of some of those comments from Janet Yellen, right, threatening some sanctions on China. Should we see them continue to involve themselves with Russia on one level or another? Let's talk a little bit about crude oil here, though, because this is another focal point as I imagine we begin the week here this Monday. Off the highs that we saw last week, but a 5-month high last week. I mean, this is in the face of some of those hopes, those expectations that we're going to see inflation start to ease and cool a bit.
Yeah, and again, you're right. It's not just metals. There's a move here in commodities, and crude oil is definitely participating as well, trading above 87, hitting $87, and we're settling in a little bit. I think once we broke out above $83, there's a floor that could be defined there, and I'm really liking to think that that we could be basing out above there and really build this next leg. Now, we came into the weekend thinking that there could be some geopolitics in the overall lifting this market. And crude oil did gap lower on the open last night, where as there's no news, is there any retaliation with Iran? There's peace talks in the Middle East. So I think right now, though, crude oil is held in really well as it sets up this week. Now, I also want to point to in the U.S., I mean, as soon as some of the news came out last week between Iran, Israel, and what could be taking place there, we did hear that the White House is going to hold off on reestablishing some of the oil reserves. But we are heading into a very bullish time of year for crude oil and energy in general. So, I mean, typically people look at summer driving season. I think it's really the rally and the lead up into June. So it's really the Memorial Weekend peak in crude oil. So I anticipate to see $90. I mean, I think we're starting to build into a maybe an overcrowded position, but I think it can get a bit more overcrowded than we are seeing it currently.
I like the reminder of some of the summer consumption trends that we should expect to see, right? Crude here now hanging out. Currently, the future is currently at 86.29, but inching its way towards your level, as you mentioned, 90. Goldman calling for 100 in the near future. Mexico not wanting to export. OPEC seeking to curb production, ultimately all adding to this rally we've seen. Talk to me, Bill, about this move higher we're seeing in commodities, right? We just looked at a few of the products that have benefited, and the bulls have been continuing this push higher, but is this a headwind for stocks, and to what extent, right? Because we were also talking earlier in the show about a series of lower highs that have played out in the S&Ps. Maybe we're just balancing, which could be very healthy, but if we start to see continued lows get taken out, like if we were to take out the March lows, for example, here's a chart in the S&Ps. We're holding above the 50, holding above the 200 still, but a little bit more sideways as of recent than we had been seeing into the middle of last month and beginning of April.
Yeah, to your point on commodities in general, I mean, cocoa was a big one that moved. Everybody's on the radar. Coffee broke out of a nice little pennant too. So there's commodities across the board. Some some of the agriculture commodities have really struggled a bit, but I wouldn't be surprised to start seeing them wake up a little bit in the coming months too. So I do think we're in a bit of a commodity super cycle. What does that mean? It does mean that inflation could uptick a bit. Now, I do think we're a little bit less about inflation when the Federal Reserve is focused. Now, we've got this inflation number coming up this week, but I do think it's the slowingness of the economy and pockets within the economy, because you look at the jobs report and you look at a lot of the things that the fiscal policy is really powering here right now. And as they're dumping money fiscally into the economy, that has fueled the stock market. And we are at record highs, and typically record highs lead to new record highs. I think when we look at the move we've had, overall, the Federal Reserve could they be a headwind if inflation starts to perk up too much, and are they not going to cut rates? But I do point to being in an election cycle, and I think you've brought up Janet Yellen throughout our interview right now. I think that the Federal Reserve is a bit more political than people think. I think they're watching the stock market a little less than people think. I do fear a bit with earnings here in the second quarter. If we get through these quarterly reports here in the coming weeks, I think that we could be on a path to really. I mean, 6,100 is the level I'm looking at. Now, I don't think that's necessarily going to happen here this year. And really what I'm looking at is a bull market that could last in through 2027. But what I would see is a continued strength into the election. And I do fear a correction maybe in the first half of next year, because, whoever it does win the election, I think they're going to have to crack down on some of the fiscal policy and work through that early in their term. So we could see what typically is a year 2 of the election cycle be moved up to year 1 of the election cycle. But that really paints a bullish path this year. So, while the market is due for a bit of a healthy correction or healthy pullback, I'm referring it to more as leveling out as we digest more inflation data to get through these quarterly earnings. But again, if we get through this unscathed, then I expect the market to continue moving higher, after consolidation here.
Bill, seems to be a sign that investors are pretty content. They're confident with what we're seeing in terms of a strong economy. The idea that earnings continue to fuel this market higher, as you mentioned, some of the potential catalysts for the bid continuing even into that longer term outlook, which I like. But this comes even as investors are comfortable with the idea that we may not get rate cuts, right? If the economy remains strong, that may not necessarily be a necessity.
Well, even when we had 3 rate cuts from the Fed on the dot plot just a couple of weeks ago, go back a couple months, but there was 6 rate cuts priced into the market, and the market had to catch up or bring that down to the Fed. And if you look at it now, according to the CME Group's Fed Watch tool, it's really a coin flip for that third cut, and it's not just after non-farm payroll. Yes, non-farm payroll did bring down what was a June cut odds from 60% to somewhere just below 50% now. But that third cut through the end of the year was never fully priced in. It was just above 50, and it's hanging right below 50 right now. And I think that's really the important thing. The market has been able to hold up here, even if it's pulled back a little bit. I think some geopolitics last week and some air pockets last week as well. People even talked about the tax air pocket, and so with tax season coming here to a head. But overall, I think the market's held up very well, while the rate market, the Fed funds futures, have priced out that third cut even to a coin flip. So I think it's less about cuts. It's a little bit about the Fed, obviously, here, and if they take the cuts off the radar for the entire year, that's going to have an impact.
Yeah.
But the Federal Reserve, they want to cut rates. I think they have to bring it down here. I think politically it's going to be something, as well as these pockets within the economy. They know that the economy isn't as strong as it is, from on the surface here because of fiscal policy. And there's pockets that are going to struggle if rates remain this high. So I think that their goal is to get a cut in and find a reason to cut in June. I think they'll try and hold to that. But I overall think that we'll kind of just work through things, and it's going to be one of those sort of years where policy stays accommodative and Goldilocks as much as it could be.
Proof positive, I think, of how the trend is your friend, right? Stick with the technicals in many ways. When you see these fundamentals that are somewhat counterintuitive to what you're seeing as far as price activity, it really speaks to the strength we've seen in the market and some of these moves across the board. Talking commodities, indices with Bill Baruch, president of Blue Line Futures. Bill, thanks for sharing part of your Monday.